One of the more common price analysis tools used by traders is Fibonacci. In today's video, we will talk about the most practical 10 uses of retracement, the best practice for building a trading strategy around Fibonacci, and other trading tips to find hypervolatility signals using this tool. First, there must be a visible trend, otherwise FIB levels won't have a meaningful impact on the price movements. No matter how often you use Fibonacci, that's most important is to use it correctly every time, and choosing the correct price swing for placing your FIBs in one of the main problem when using Fibonacci is effective method, but you must place it on the shape that makes the most sense for current market conditions. The most important aspect when using FIBs is the present or the trend. There are two primary ways to solve the problems with drawing FIBs on the chart. First, focus on trend and movement. Second, using logic price swings for placing the Fibonacci tool. Please remember these FIBs do not work well in consolidations, corrections, range and sideways moves. Seconds, don't use Fibonacci retracement tool on very small price movements or shorter time frames. Applying Fibonacci retracements over a short time frame is ineffective. The shorter the time frame, the less reliable the retracement levels, making it very difficult for the trader to rely pick and choose what levels can be retraced, not to mention in the short-term spikes and false breakouts are very common. These dynamics can make it especially difficult to place stop or take profits, as retracements can create narrow and small confluences. So try to focus on the large time frames when you apply FIB levels. By keeping tabs on the long-term trend, you can apply Fibonacci retracements in the correct directions. Future, if you use the Fibonacci retracements tool on a very small price movements, it may not provide much insight. The levels will be also posted together that almost every price levels appears important. Third, apply Fibonacci retracement levels on the correct price swings using a Fibonacci retracements tool is subjective. There are multiple price swings during the trade days, so not every will be connective the same 2 points. The 2 points you connect may not be the 2 points are the connect. There's how you correctly apply FIB retracements. You determine the dominant trend. You identify the swing high and swing low before drawing the Fibonacci lines. In a bullish trend, drawing the Fibonacci from the swing low to the swing high. In the bearish trend, draw the Fibonacci from the swing high to the swing low. You will be drawing the Fibonacci tool from the week of swing highs and lows at the very basics. The clear, the swing low is the clear where the swing high, and the clear where the trend between these 2 points. The more accurate Fibonacci retracements will be. Also very important, don't try to force FIB levels. The best and the most helpful Fibonacci retracements are those where you don't have to look long on the chart. Force shallow as deep retracements is trending or impulsive markets. The FIB levels indicates price levels where there is a high chance of the market turning back. in the direction of the trend. Basically, FIB levels provide areas of interest to watch on the pullback. There are two main types of the pullback using Fibonacci: shallow and the deep retracements. If you correctly analyze these trends or the trend, you will have hyper-viewed areas to take trades. Once a trade has clearly established itself, then you will often see a shallow pullback to 23.6, 38.2 and 50% FAB levels, which are very typical before the trend continues. So when the trend is strong, pay attention to these FAB levels. Price will make a deep pullback when a trend is not yet clearly established. In those cases, price can make multiple ups and downs, which will test the bottom in an uptrend or top of the downtrend, but without breaking those levels, which would involve the trend. You will see deep pullbacks to 61.8, 78.6 and 88.6 FAB levels. If the price retraces 100% of the last price wave, that may mean the trend has failed. Fifth, the global ratio retraces straight to 61.8 levels is called the global ratio. Here's how the global golden ratio retrace strategy works. In this example, we found this downtrend and applied to the FABs. If the price moves up above the 50% retracements but does not close above the 61.8 gold ratio, look for the bearish entry. It is okay for a week of the candles to break the 61.8 line as long as the price closes below it. As the price bounces from 61.8 golden ratio, look for the possible reversal move back down to the 38.2 level. If the price breaks the 38.2 level, the 23.6 maybe its next hesitation point. If that doesn't hold, expect to the possible 100% retracements back to the zero line. These levels are good potential ways to consider scaling out of the trade. If the price never gets higher than the 61.8, then you can set your initial stop just above that line. If the price went higher than the 61.8, then you could set a stop above the high of the candles that broke the level. If scalping out the trade, consider moving the stop of the next FIB line as the target are met. 6. Combine multiple FIB retracements to create the confluence. Fibonacci confluence is essentially combining multiple Fibonacci levels to find the clusters where these levels alike around the same area. This example reversal an area of the confluences formed by the 50% retracements or AC waves, the 78.6% retracements of BC wave. In this other example, price found support, and this area of the confluence formed by the 50% retracements of the AC wave and 78.6% retracement of the BC waves. In this daily chart, this is one of my favorite trading strategies using Fibonacci because it leads to high probability setups. 7. Confluence might moving average. Fibonacci can provide reliable trade setups, but not without confirmations. Applying additional technical tools like moving average will support the trade opportunity and increase the likelihood of the good trades. Fibonacci and moving average work well together because both tools are most effective in a trading environment. First of all, using moving average will help you to determine if there is a trend. Second of all, moving average also acts as a dynamic support and resistance in a trend, which means that a moving average adds a confluence to FIB levels. For instance, if the 50% Fibonacci retracements and 200 EMA alight at one spot on the chart, then this is called trading confluence. There is a combination of the elements join together at one point of the chart. When FIB levels and the moving average are confirmations spot on the chart to be important, then the likelihood of the price reaching to this level increases. Again, this is very effective because by combining the FIBs with moving average, you remove the weakness of each tools when used separately. 8. Confirm Fibonacci levels with volume as target. When you see the price coming into Fibonacci support area, the biggest clue you can look for this volume to see if the support will hold. Notice how the stocks had a number of spikes higher in the volume on the move up, but the pullbacks to support the retracements saw volume decreasing. This does not mean people are not increased in the stock. It means that there's fewer sellers pushing the price lower. This is where buyers come in and assimilate shares in anticipations for the rely higher volume after the rejections of FAB levels represents a very good sign. 9. Look for the divergence at FAB levels using RSI, MACD or Stochastics. Now razor the binding and turning into the trade because it hit a particular retracement ratio. You need a confirmation signal so that our price is likely to turn. I prefer adding a momentum oscillator like RSI, Stochastic or the MACD and look for the divergence signals forming around FIB levels. These are leading signals, but the way they will These are leading signals, by the way. These have the downtrend with the FAB levels added to the chart. The first levels, the 38.2% level was broken with sales. However, we can now see that the 50% level is providing some resistance. We can confirm the slowing momentum with the other side. The other side is showing divergence, which is bearish signals as well. Price makes higher highs, but the oscillator makes lower highs. This means the momentum is slowing, and slowing momentum into the resistance level is a good price for the trading opportunity. In this example, we have an uptrend with a MACD indicator showing a high divergence here. When the MACD high divergence appears on the price chart, the price reached the 38.2 FAB levels. When price tested this Fibonacci retracement levels, this would have been a good levels to enter in the directions of the main trend. 10. Analyze candlesticks formations around FAB levels. Analyzing price actions at FAB levels represents another effective way to take signals. In this case, traders wait the candlesticks patterns to occur at the Fibonacci levels instead of only anticipating a price reaching at the FIB. In this way, the candles patterns confirms the represents of the market at the FIB levels. Generally speaking, these candles patterns combined with Fibonacci levels tend to work better on longer term time frames. When price reach FIB levels, you look at the rejections candlesticks that has formed at the near the level. There are three types that are the most interests will be harmed candlesticks, which is often seen after a bearish price move. These shooting stars candles, which is often seen after a bullish price moves, and the engulfing patterns, which can enter to be the bullish or the bearish variety. These candles reversal patterns are quite powerful. and can't foretell the end of the retracements moves. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and hit the bell icon to stay in touch when we release a new video. Until next time.